Hi again, folks. Welcome back to Meaningful Money, still in my field. We're going to talk this time about asset allocation, a really important part of investing, and particularly about reducing the risk of losing money when investing. So this is right at the start of the whole investment thing we're going to have going on for the next, well, many weeks probably. But asset allocation, what is it? Well, asset allocation is the process of determining how much of your money you should put where. So how much, let's say you had £100,000 to invest and you wanted to invest that specifically for your retirement, and you and I have done a great deal of work to establish how much you need that £100,000 to become, say, let's call it £200,000, and we got a 15-year window to achieve that. How much do we put in shares? How much in property? How much in gilts, bonds, private equity, hedge funds, timber, commodities, gold? There's many things you can invest in. How much do you put in where? And we also need to bear in mind your time scale, and we need to bear in mind the risk that you're prepared to accept as well. So this is a really, really important subject. So it's how much you put where. Now, I say it's important. It's much more than important. It's absolutely essential. There's been quite a bit of research done. And one piece of research in particular gives a figure, a percentage figure of how much each, that's an awful way of explaining. Let me start again. This research done by Ibbotts and Associates in America assigns a number to the impact of various aspects of investing, the impact, the wasp just in front of the lens, the impact that each of those things have on the eventual returns. So you can expect, let's say, things like market timing, whether you get in on a good day or a bad day, and get out of the market on a good day or a bad day. You'd think that would be quite important. That would have a big impact on the eventual performance of your portfolio. Actually, the Ibbotts research reckons it only accounts for 2% of the overall performance of a portfolio. Just 2% is determined by when you get in and out. 5% of a portfolio's performance is attributable to the things you choose. So that means, let's say we decide that in your investment we're going to buy some shares in an oil company. Perhaps not a brilliant example right now with everything that's going on with BP, but there's a few oil companies. Let's say we chose either BP or Royal Dutch Shell, for example. Well, 5% of the total performance is attributable to getting that right. Do we choose Shell or BP? So stock selection only accounts for 5%. According to the research, 2% is attributable to other factors, not quite sure what they are, but a massive 91% of the total performance of your portfolio is down to asset allocation, getting the mix of your assets right. So to say it's important is a massive understatement. It's absolutely crucial. And you'll be, I'm afraid, disappointed to know that it is not an exact science. There's many things to bear in mind, not least because we as people are driven massively by emotions. If we were computers, then it would be easy, but we're not, and no matter what somebody's risk tolerance is on paper, when things are going south in the markets, then that risk tolerance is tested. So asset allocation then is essential. It accounts, apparently, according to one study, for 91% of the total performance of a portfolio. Vital. But there's so many things to choose from, it's difficult to get it right. So we've got cash at one end, gilts, corporate bonds, property, equities, private equity, hedge funds, commodities, infrastructure, timber, gold. That's 10, pretty much off the top of my head. Not quite, they're on a script just below the camera, but I just thought of them just now before I started filming. That's at least 10 things, and there's plenty more. So asset allocation is determining how much to put in each of these categories, if any. How do we decide that? Well, the thing to know about each of these things that I've just reeled off in that list is that they behave differently. You see, if you're going to spread your money over different baskets, there's no point putting all your money into 5 different property funds, say, and calling that diversification. It's clearly not. Just because you've got 5 different funds and they're managed by different people, it's all still a property play, and if property suffers, your money will suffer as well. So that's not diversification. We must invest in things which behave differently. So the classic example is buying shares in an umbrella company on one hand and an ice cream company on the other. So if you have an awful summer where it rains a lot, then your umbrella shares are going to do well. If you have a warm summer, your ice cream company shares are going to do well. But the reverse is true as well. If you have a warm summer, though your ice cream shares are going to do well, your umbrella shares will suffer, and vice versa. So having them both means that you're going to win some, no matter what the weather. And so good asset allocation must diversify your investments across things which behave differently. Another key difference between all of those things is whether they produce growth or income, or a combination of the two, which many things do, and whether they're particularly biased towards income. So gilts and corporate bonds, for example, are income producing assets. They're even called as a class fixed income. Whereas some smaller company shares, for example, might not produce any income. It's all about growth or loss in some cases. So what each individual kind of asset class produces is an important factor in determining whether we choose them or not. We talked last time and a couple of videos ago about time scale is really important. It might take a long time for some investments to pay off. Some might be a quick win. The need for income is a big one, and risk is a massive factor. So I'm going to blow your mind, I'm sure, in this video, because it's such a big deal. It's so important, but it's so very, very difficult to get it right. In fact, it's so difficult to get right that at my company, Jackson's, we decided 5 years ago that we wouldn't do it anymore, that we would leave it to the experts. And we partner with an excellent company in London called 7 Investment Management, and they do a fantastic job of asset allocating for our clients. And we're glad that my clients can sleep at night and I can sleep at night knowing that it's not up to me to choose. So that's asset allocation, determining how much of your money goes where. It's really important. It accounts for 91% of the total performance of your portfolio. There's tons of things to choose from, and how you choose the split between them depends on timescale, risk, the need for income. So that's asset allocation. What we're going to do now is begin to drill down into those different asset types: cash, gilts, shares, property, all those stuff, and I'll explain to you what they all do, how they behave, how you invest in them. That's going to take us a little while, so stay tuned and see you next time.